The Federal Reserve has lowered interest rates for the second time this year. Today, the Fed announced a rate cut of 0.25%. This is what economists had widely expected, but it's not as much as the last rate cut in September. That was double that amount. And we have Jacob Sonenshine joining me here on set in Studio 57. He's a market reporter at Barron's. So, Jacob, we expected that it was going to be a quarter rather than 0.5%. But why didn't the Fed cut rates as much this time as they did last time?
You know, PCE, which is the Fed's preferred gauge of inflation, was 2.1% year over year in the last reading this fall. The Fed's target is 2%. Right. We're actually almost there. And if you look at the two-year Treasury yield, that is basically a barometer for the bond market's expectation of where the federal funds rate will be in the future. That's at about 4.2%, not really moving much. The Fed funds rate is just below 5%. So the bond market is saying we don't need that many more cuts. We're almost at 2%. And there's a lot more to the picture, but we'll get there, I'm sure.
Well, so when we're talking about getting there, the next time the Fed meets is going to be in December. What should we expect about what, if any, interest rate cut will come out of that?
The Fed will probably do a quarter-point cut in December. I would be actually really surprised. They did if they do a half-point cut. They did a 50-basis-point cut in September because they wanted financial markets to ease up. They wanted financial markets to be aware that the Fed has the economy's back because they can do that. Inflation is almost down to 2% now. I think we'll get a quarter point in December. But what you have to really focus on is the dot plot, which is the Fed's projections for more cuts. Again, bond market just above 4% to your Treasury yield. Bonds are saying, I don't think we need a lot more cuts.
And we're also looking at the other data, including the rate of first-time unemployment, how much our economy is growing in terms of new jobs. All of that means that those indicators are all steady. But we've just had a major change, really. We're talking about a new administration coming in January. And President-elect Trump has focused a lot on what he wants to see as changes in the economy. How might some of his proposals, including mass deportation of undocumented immigrants, increasing tariffs on foreign goods, how might any of those impact how the U.S. economy is doing?
Trump has a lot of policies that, in terms of economic demand, are conflicting. They're sort of push and pull. Fiscal stimulus, cut taxes, more demand, more inflation. Tariffs, more inflation, but it hurts demand. So ultimately, after some inflation would probably go down. Deportation, these are economic negatives. There is some inflationary stuff with some of these policies. The Fed can't really take that into account yet. And they're not really going to answer questions about Trump. They'll field questions, they'll listen to them, but they're not going to say much until policies haven't even rolled in yet. Trump takes office in January. If you want a great indicator for where rates are going, look at the two-year Treasury yield, because the two-year Treasury yield, to your point, is saying we have some inflationary policies that are probably coming in over the next couple of years, and we think maybe one or two more rate cuts, but there's a case to be made, and the bond market is making it, that you don't need that many more rate cuts, and you might get inflation above 2% with a Trump presidency.
So, Jacob, I just want to rewind for a little bit because we're talking about bond markets. There was a lot of talk yesterday about how the stock exchange was responding to the news. But when we're talking about what we saw in that last election, we're seeing people responding to what they feel. PCE as an indicator of that, but more importantly, what they're seeing in terms of housing prices, grocery prices, gas prices. When we're talking about this big news coming out of the Fed today, 0.25% rate cut, which isn't surprising to people who are in the financial sector, help our viewers understand what that's going to mean for them in ways that have consequences for their actual wallets.
You're talking about the level of prices right now or a Trump presidency, what that means for them?
Level of prices with the Fed.
Exactly.
Move on from the Trump presidency for a second.
Oh, sure. This week it's just been, you're writing all about Trump and markets and all that stuff, right?
What we learned from the election is how much people are frustrated.
Absolutely. So the rate of increase in prices is going down. That's great. That's what the Fed wants to see. But guess what? When you get 9% inflation in June of 2022, and then you go down from there 6%, and then now just around 2%, cumulatively, it's a ton of inflation. So the level of prices are starting to eat into consumer demand right now. Also, rates, even though they're down from peaks, they're still above the middle of their range over the last few years. Because remember, we're coming from 0% in terms of short-term rates. So the level of rates, still high. The level of prices, still high. That is eating into so the economy is still growing, but it's slowing things down. And I think it is part of why the Fed still wants to do a couple more rate cuts. And the bond market is still saying maybe 1 or 2 more rate cuts.
Yeah. And part of that, I think you're making such a good point. We have seen this inflation, and all the times that we talk about the inflation rate coming down, it doesn't mean that prices are actually coming down, because those prices have continued to increase over this time period where we've had great inflation. Jacob Sonenshine, thank you so much.
Thanks.